it's definitely this experiment, like modern monetary theory is neither modern and neither a theory. I mean, it's like, like it has a beautiful name, but really reaching out to the future and spending money, our kids' money, spending money we don't have to make sure that we can keep our lifestyle, we can survive through bad times, is definitely, I grew up poor like you, and that's not how my parents taught me, right? I mean, life has great moments and has moments that you have to basically get through, right? And here, again and again, we're bailing ourselves out by reflating our economy, and each time we're printing an order of magnitude more dollars to do that, right? I mean, if you look at the 1987, right? We did that in 87. We did that in 91. We did that again in 2000, 2008. And now we're talking about, again, what is going to end up being tens of trillions of dollars. So if you had to recommend to somebody, how they should treat their assets today, what would be your asset allocation?
Well, I just suggest doing the same thing that I do for myself, just because I try to keep it simple. And I use this portfolio setup that I call 10-80-10. So just 10% insurance, 80% investments, which I consider, or I define as something that pays you to own them. And then 10% to speculative assets. And speculative, it doesn't mean that's not a negative connotation. It just means that they're not paying you to own them. And so I would put Bitcoin in the speculative asset class, meaning it might not pay you to own it, but it's got some incredible asymmetry. And I would put uranium in that category. I would put the gold miners in that category. As far as the insurance side of the portfolio, for me, that's just physical gold, just because I'm not trying to get rich off that. I don't even care if it goes up in price, just so long as it maintains its value or it maintains its purchasing power.
In case there's real disaster, right? Like in case everything just breaks down, you
yeah,
need
and it's a good cash hedge. So you always have some cash on the sidelines, and you always worry about the cash going down in value. If it does, most likely the gold will go up slightly and just kind of act as a counterbalance there. But the main thing is with the 80% of the portfolio, it's just paying me to own it. So I can get it wrong. I don't have to get it right. I don't have to know what the price direction is going to be. What I did in 2012 was a perfect example of that. I didn't know if home prices were going to go up or down. Who knows? In fact, I thought they'd probably continue to go down, but I didn't care, because the cash flow that I was receiving from that asset was so staggeringly high that if I kept it for the next 40 years, I don't care what the price is doing in the interim. Right. I'm not selling.
It paid for itself several times over. But for people that need to make decisions today, you're lucky. Again, you bought a portfolio right when the real estate was bottoming. You invested in it, right? You created a lot of income properties that kind of continue to pay. And again, as you pay off your debt or mortgages or whatever, it's all free cash flow. So people that have to make these decisions today, they can't, right? I mean, everything, like you said, it's an everything bubble. Real estate, even though Corona is obviously hurting the economy, is at all-time highs. I mean, you can't get, like, you go to Florida and you try to buy something, unless you are going to overbid by 10 or 20%, you're not going to, no one even going to talk to you. So, what people, young people that have to make decisions today, right? They don't have that much to invest. Do you still recommend for them to buy income properties, or what would be in that 80% that is supposed to pay yield? Where do you go for yield these days?
You have to go overseas for yield, to buy things when they're cheap. And so then it becomes a question of, I'm assuming most of your viewers, their expenses are denominated in dollars.
So, about half, yeah. Half are Europeans, half are Americans. So
okay. You know. So you have to be cognizant of that, because if you've got whatever currency your expenses are denominated in, you can't have a portfolio that's 100% other currencies, because then you're taking quite a bit of risk if it goes the wrong way. So for young people, or just the kind of the average Joe, I think that you've got to own some precious metals. I think it's extremely wise to own some Bitcoin. And then with the other part of your portfolio, you've got to look around and get outside of maybe the European Union or maybe the United States, because there are things out there that have very good value, that are cheap and are going to do well if you believe the future for the global economy, for that matter, is going to be inflation because of all the money printing, if you want to use that term, from the central banks, or the fiscal deficit spending that's being monetized or will need to be monetized by the central banks. So and another thing too, that just the average ordinary person, maybe not in Europe, but definitely in the United States, can do, is they can make sure that if they have a mortgage, whether it's on a rental property or their own, where they live, to make sure that it's a 30-year fixed rate mortgage. Make sure you've got that, because what most people don't realize is that's a hedge against the dollar. Now that's actually a short position
Exactly.
against the dollar. And
the
if
bank
you
is taking the risk on the devaluation of the money, not you, because you have the property, they have the debt, and hopefully again the dollar does lose its value, but your home increases in value, and you coming
or your cash flows, let's just
right.
assume that your cash flows go up with the rate of inflation. So I mean, let's take an extreme example. So you buy an asset or property right now for $100,000. Let's just assume that it's paying you $1,000 a month in rent, and let's just assume your mortgage payment's $500. Well, your mortgage payment's going to be $500 for the next 30 years, but is your rent, the rent income, going to be $1,000? Absolutely not, especially if we get significant amounts of inflation. So let's say that we get 1970s type of inflation over the next decade. At the end of 10 years, you could be charging, who knows, $10,000 a month for rent, maybe $15,000. And that sounds astronomical, but just remember, it wouldn't have any more purchasing power than the $1,000 you're getting right now.
Right.
But your mortgage payment would still be $500 a month. So that would be obviously a much larger delta, not just in nominal terms, but in real terms as well. So that's a transfer of purchasing power from the bank or the lender to the borrower. And that's why, in my mind, it is true that real estate is in a bubble right now in the United States. There's no getting around that. There may be pockets of opportunity if you're an expert to find a motivated seller, if you really know what you're doing. But we live in such strange times that the way I'm looking at real estate in the United States, as I'm looking at it as though the property is actually the liability on your balance sheet, and the 30-year fixed rate mortgage is the asset. You see, back in insane times, obviously the property would be the asset, and you would expect that to go up in value, or you would expect to make the money on the asset, and you'd expect to lose money on the debt because of the interest you're paying, because you're paying back more than you borrow, right? But now I think it's the opposite, in the sense that you may lose money on the property because the prices are at nosebleed levels, but you may make even more than you lose on the debt, because you're paying it back with those cheaper dollars. So, and I'm not saying everyone go out and do that, but that's kind of an interesting way that I'm thinking through the real estate equation right now in the United States. But the bottom line is, for the average person, my goodness, own some precious metals, own a little Bitcoin, something with asymmetry there. I like some of the commodities as well, but then make sure that if you do have a mortgage, it's a 30-year fixed rate.
Right. So I wanted to ask you, because you're very vocal about your thoughts and views on everything that's happening with central banks and the Fed and obviously Treasury. And it sounds almost like I agree with a lot of your views, and it sounds like no one is listening to us, right? I mean, the party is going on, the music keeps going, and everybody looks at us and say, "Oh, you guys, you don't understand anything. This is what it is now. This is the reality. Like, you guys live in the past. You listen to Milton Friedman, you listen to all these people who don't, what do they know? So what's your view on what is a trigger? Like, what basically event brings reality back and stops the music? Obviously, right now, the Fed has done a phenomenal job putting a safety net under the U.S. economy, right? Basically reflating the markets, being the Fed put, right? And guaranteeing that everybody who invests in stocks or bonds or whatever is not going to lose their money. And right now, there's no moral hazard, right? Everybody thinks that trees can go to the sky. There's no gravity. So what event triggers the pendulum to start swinging in the other direction?
Well, I don't know that they've done a good job in micromanaging the economy. I would say they maybe have done a good job in instituting a Fed put and creating massive asset bubbles and distortions in the financial economy and completely destroying the price signals and the price mechanism and price discovery. And they have kicked the can down the road, but in my opinion, they've made the underlying problem and the real economy far, far worse. And I think, I just did a video yesterday and it was on this topic. Most people see wealth as money, or better stated, currency units. So if you have more currency units in your account, your bank account, which by the way is just an IOU for IOUs, but most people—
IOUs from insolvent institutions.
Well, IOUs for IOUs, because
Right.
they owe you dollars, which are IOUs. So anyway, but most people think that if that little number goes up, then they are wealthier, and therefore, if everyone in society's number goes up, then we are wealthier as a society. I don't know how we've gotten into this mode. I don't think it's purposely being brainwashed by the central planners and the teachers in our school system, but they did it unintentionally, and they did a very good job. The wealth of our society is not measured by how many currency units we have in our bank account. It's only measured by the amount of goods and services we create efficiently. Period. It's productivity. If you were stranded on a desert island and all you had was a big chest full of $1 billion, or gold for that matter, or Bitcoin,
Right.
you'd still be dirt poor,
Right.
because you don't have any goods or services, right? So that's got to come first. So when you're asking yourself the question if the Fed has done a good job, you've got to ask yourself, well, do we have more goods and services now than we did back in 2010, 2008? And the answer is no.
We were now going into the biggest recession, maybe in all recorded history. So, as you remember, my thesis was liquidation phase, which was into March. Then I closed out on my shorts. Then it was going to be the hope phase. And then it was going to be the kind of insolvency phase. So the hope phase happened. And that was built on vaccines and things are going to be okay and herd immunity and all the narratives that happened. But something different happened as well. Interesting enough, the real-time economies never really picked up for a while. They did exactly kind of as expected, but the markets did. The markets did the opposite. I said we'd probably finish the year at kind of -3 to -5% year-on-year GDP growth, and that's exactly where we got to. So the hope was misplaced because the economy was shit, and people had been laid off, and there's structural unemployment, and many of the people in retail, for example, are never going back to jobs again. So there was a real structural problem. The insolvency phase should have been that the triple B entities, the giant corporates, should have run out of cash because they didn't have enough cash flow to paper over the debt payments that they need to make. So it becomes harder and harder, their equity price falls, and it all becomes more difficult. But that was also going to happen at household level, where households were, yes, some people were furloughed, some people were given payments, but eventually the payments stopped, and if they didn't have jobs, the musical chairs stopped, and you're kind of screwed. And the same with small businesses. So we saw immediately the government do something it's never done before, which is instant transfer payments, which was stunning move towards a more MMT style environment where fiscal policy and monetary policy are roughly the same thing, or they work hand in hand, which is what we've seen in Japan over the years. That was amazing. It helped a lot of people and basically delayed the insolvency phase. Technically, many firms, many people, many businesses are insolvent, but they're kind of being kept alive by the central banks and the governments. And still to this day, we're still in that same cycle. It's become apparent, and I talked about it in the past, is governments and central banks have to do absolutely everything to avoid the insolvency phase. My guess was they were unlikely to resolve it all, and I think it actually plays out longer, and it is actually in reality in play, but we're not going to know until we try and revert back to some sort of normality. This is one of the key reasons why the central banks simply cannot allow rates to go up, because you will destroy any chance of recovery. So anything, if the market wants to go there and try and price in higher rates, yield curve control is going to kick in. We've got pseudo yield curve control in Europe, and we've got yield curve control in Australia, we've got it in Japan, and I think it would come in the US. And that means that rates can't actually price inflation. Now, I'm not an inflationist. I think we will get cyclical inflation because of the supply constraints and the massive rise of people coming back into the labor force and back in economic life. But as we settle down, I think the debt deflation narrative, technology, globalization, aging population, all of this stuff continues to weigh on inflation. And over time, as the economy settles to trend rate of growth, potentially inflation falls. I actually think trend rate of growth might change positively. And I'll come on to that at the very end of this, but it's not really a piece for this, and that all comes later. But it's the macro backdrop of that is very important to understand, because within this, the only answer was the creation of more money. And that creation of more money was clearly going to be very, very beneficial to Bitcoin, because it was basically created for this. And I pointed out early on, back in March and April, that Bitcoin was two things. It was this store of value narrative. And it also had a call option on the future. And I started developing some big meta-narratives to help get people across the line, because I know it's a scary, different world and people don't want to understand this weird digital money. I don't want to throw money at this. But I tried to explain to people in simple terms things like pristine collateral, how this is superior than many things that we have in the existing system, or in fact, all of the things that we have, how it acts differently, how you can't create more of it, so as collateral it's worth more, and therefore is a better foundation stone for the financial system of the future, and how as a store of value, it offsets the monetary printing, and how this could all transition into a future economic system that had incredible value. And that's what made me irresponsibly long. And that, I think, helped a lot of people get across the line. The next part of it that I think was maybe the light bulb moment for many was my New Bretton Woods, the Bitcoin life raft piece. And that essentially was saying that, okay, what also is coming is the central banks have seen this digitalization of money and they want to be involved. And they want to be involved by creating central bank digital currency, not as a competitor to Bitcoin, but as an ancillary agent within this new digital money system. And that's all well and good. That's basically government stablecoins. Fine, I get it. It's much better. It works really well. But it also has other qualities, because the other qualities are it's programmable. So essentially, central banks can program money so we all have different monetary policy or different tax regimes or whatever it may be. The point being is behavioral economics is going to shoehorn its way in to monetary and fiscal policy, which are combining. And at that point, we are really beholden to what central banks do. Can they destroy money? Can they destroy our capital, our savings? Of course they can. And we needed a life raft. And Bitcoin was going to be it. Now, as we wind forward, we're now seeing pretty much every government on earth running record deficits. This means that theoretically they're all bankrupt. But we know in this modern world of printing of money, bankruptcy in governments doesn't mean the same thing unless you can't print money. Hence why emerging markets go bankrupt, developed markets don't. So the answers to these record deficits is all the story of debt, really, right? How do you finance that debt? Well, you finance it in the age-old way: taxation, inflation, and debasement. So taxation around the world is going up everywhere, without question. And there's very little things you can do about that because of the legalities, whether you like it or not. But inflation and debasement, they're two different things. Now, central banks around the world have put inflation targets that are higher than where we are now. Will they be able to meet those? My view remains, and has been for the last 20 years, or maybe even 30 years, no. I don't think inflation is structurally able to be generated. I could be wrong. Of course I could. Let's wait and see the massive amounts of fiscal stimulus that has to come. Because these deficits aren't going away. There's another round of huge stimulus to come this year in the US alone, let alone Europe. Now, Europe is obviously slowing down with the virus again. There is more stimulus to come. And there's more stimulus almost everywhere. And so I don't think maybe that infrastructure spend generates inflation. Maybe it's just cyclical. Maybe it's structural. Maybe everything changes. I do not see how you get around the rise of technology, the aging population, globalization, and the dynamics of debt. I don't know how you generate inflation in that. So let's assume that that doesn't happen. It's cyclical, it spooks the bond market, the Fed do yield curve control and expand their balance sheet again when that happens. So that's an interesting thing. But monetary debasement is the thing that I thought about. And I think people confuse inflation, CPI, and debasement. You see, most people are looking for the dollar to collapse, not really thinking through the fact that everybody else is also printing money. And it seems to be, sure, the dollar might go lower when they're doing more than the Europeans, but overall, if you look with honesty at the DXY, something that I was expecting to see break higher, either dollar higher over last year, and it didn't. And but when I look at the chart, it didn't break lower either, because everybody thought that. It kind of looks like it's range bound at about 96 as the average. So therefore currencies don't move. But that's interesting. That got me thinking. And rates can't really move either, because if they go up, then yield curve control comes in. If they go down, they're going to try and stimulate more. So then rates kind of drift higher a bit. So let's say US 10-year rates are maybe range bound between 0 and 2%. Maybe they go negative, maybe not. But either way, there's no rates trade to be had. The death of macro in rates, I think, is writ large. And I know many people think, no, you can short rates forever. Inflation's coming back. Yeah, but the central bank are not going to do that. And we've seen that in Japan. So what's very interesting is that as yield curve control comes in, it means that they buy bonds, and the central bank buy bonds by printing money. So I've looked at that, and I looked at, okay, if there's no inflation, then where is this monetary printing going? And the argument had been for a long time that I didn't agree with, that QE found its way into financial markets. And I thought, I don't see that mechanism per se. Of course, it finds its way in some places. Wealthier people, corporates with better balance sheets find it easier to borrow. You see it, in the credit markets, how easy they are, that kind of thing. I get that. But the equity market was the one that didn't really pass the smell test, because the equity market rose on the back of QE, but volumes didn't. So then what's the buying? Where is the buying? What's going on? And at that point, I started looking at the chart of Bitcoin versus other assets. And many of you will have seen this in Macro Insiders and also on Twitter. And so what became clear, and this was we're now talking about September, October last year, that Bitcoin had already and was about to outperform every single asset on Earth. So all of the charts of, let's say, Bitcoin versus the S&P, Bitcoin versus the NASDAQ, Bitcoin versus gold, Bitcoin versus real estate, Bitcoin versus anything I could find, any asset. Sure, you can all find a single stock that's done better, but an asset class. Not one asset class on Earth looked like it was going to outperform Bitcoin. I'd never seen anything like that in my entire career. That made me pay attention. And then I put it against the Fed balance sheet. First, I looked at the S&P versus the Fed balance sheet, because the Fed balance sheet is the purest expression of monetary printing. I also use the G4 central bank balance sheets to look at the global printing of money. But let's use the S&P versus the Fed balance sheet. You can see the chart here. The market basically fell in 2008 80% and traded sideways ever since in this chart. What's interesting is gold looks similar. So if you look at the chart of gold divided by the central bank balance sheet, it looks similar. And if I look at the chart of real estate versus the central bank balance sheet, it too looks similar. But if I look at the chart of gold, which is the oldest denominator, the form of money, against the S&P doesn't look particularly expensive. A little bit expensive, but not the bubble that we're seeing. And that got me thinking about these relative asset prices and the fact that Bitcoin was outperforming everything. And I realized that I think we're all looking at this wrong, and I certainly had been. What that chart shows, or those charts, is that the denominator, which is not the US dollar per se, but the value of fiat currency in terms of what assets it could buy, because these are all fixed assets essentially, or low supply assets. Anything that was a low supply asset was going up in price, but it was going up in price in dollar terms. But when you look in money printing terms, they were basically holding their own after the massive collapse of 2008. And that intuitively feels right to us. You know, the anger and the frustration and the economic misery that's happened since is a function of that. And that makes sense. Variable inputs like consumer goods and wages were destroyed by this. And that makes sense too. So with your wage, you were able to buy less assets. So if assets are a way to create savings for future consumption, you were able to buy less of them. And so in lies the pension crisis. So in lies the ability for millennials to buy housing. So in lies why the middle classes got holed out.
Let's start at the beginning here with what I find very important to follow, which is sort of, well, I call it the flows of money throughout the market. You know, when say gold and stocks and the dollar go up or down or whatever, where is that money going, and so on and so forth. So my question here is, I guess, where do you think money is going right now within the market space, and where is it coming from?
It depends what time frame you look at. I mean, over the past year or so, a lot of it's poured into asset prices. And so, one of the things I focus on in my research is, how the different changes to broad money supply impact different economic indicators or different assets. And so, if you look back historically, if you have a pretty big growth in broad money supply, which of course is different than base money. So a lot of people focus on central bank balance sheets going up, but that's not the same thing as broad money supply, because there's not necessarily a transmission mechanism to get that out into the broad money supply, although sometimes there is. And so, back in 2008, for example, 2009, when we had all that QE, we did not see an increase in broad money supply, above the normal baseline, because most of that money just stayed up in the banking system. Whereas what we saw here in 2020, and then going into 2021 here, is we actually did see, all that QE got out into the broad money supply due to all the fiscal spending that they did. And so we've seen people's checking accounts go up, savings accounts go up, currency and circulation go up, and naturally that goes somewhere. And so, where it goes generally depends on what's scarce. And so during certain times in history, say if commodities are scarce, it goes in towards inflation. So broad prices across the board start going up. Over the past decade, because we've been in a period of commodity bear market, commodity oversupply in general, we haven't seen that kind of raw price inflation down at the commodity level and at the goods level. We've seen kind of targeted inflation, like we've seen healthcare keep going up. We saw mostly service-related stuff, so healthcare, childcare, university fees, things like that, things you can't really outsource, things that you're paying someone else to do. Whereas anything related to electronics or commodities has generally been disinflationary or sometimes deflationary. So instead, as we've increased the money supply, a lot of things have flowed into financial assets because if someone has a lot of money, the thing that's scarce is where to put that money and what you can put it in to get, say, the expectation of a reasonable return. And so when you have a big increase in the broad money supply, but you don't have commodity inflation yet, you don't have higher interest rates yet, well, then it pours into tech stocks, it pours into gold, it pours into wine prices, real estate prices, literally across the board, collectibles, Bitcoin, pretty much anything across the board goes up in price.
Mm-hmm.
And then now, over the past, several months, we are seeing it, get more and more into commodity prices. We've seen, agricultural products go up. We saw copper go up. Oil's still cheap in the grand scheme of things, but it's up compared to, what it looked like last year, in the kind of the heart of the pandemic. And so overall, that's kind of how it's played out, where it's largely poured into asset prices, but now it's pouring into, some more commodities and some more value-oriented things. And I guess the question of where it comes from, that depends how far back you go. But this latest surge of broad money supply came from the combination of fiscal and monetary responses. And so I've used the analogy of like two generals with like nuclear keys, where if you watch a movie and they want to like launch a nuke, you need like two generals like put their keys in at the same time. Neither of them can do it alone. And when it comes to increasing the amount of broad money supply in the system, neither the fiscal authority, so the Treasury and Congress, or the monetary authority like the Federal Reserve, neither of them can really do it alone under the current legal structure. They both have to be involved in order to do it. And so the Federal Reserve can create new base money, but they can only buy assets with it. They can't just hand it out to people. They don't really have that legal mechanism. On the other hand, the Treasury can send money to whoever they want if Congress approves on it, but then they have to issue bonds to pay for that, and then whoever buys those bonds, it sucks money out of the system somewhere and basically puts it somewhere else. But when you have that combination where the Treasury sends money to people, issues bonds to pay for it, and then the central bank creates new base money and buys those bonds on the secondary market, well, then you've just injected broad money supply into the economy. And that's what we've seen over the past year.
Would you say that regardless of that type of environment we're headed for, whether we stay in this one or we transfer to a different type of environment, commodities are then likely to outperform equities?
I think there's a good chance for that, especially over a long enough period of time. There's always certain quarters where if you have an economic shock, you could have a fall in commodity prices, especially because, these days China is such a large, it's the world's largest importer of commodities. And so people are often looking at what the United States is doing as far as, commodity prices or economic growth. But, in the global sense, China is the biggest driver of commodity prices. And, as you go further into the 2020s decade, a lot of people are expecting India to kind of, become an increasingly important part of the commodity market as well, assuming their growth trajectory, continues at any similar pace that it has been, given their very large population. And so there are multiple factors kind of shaping up for the 2020s decade to likely be, a better decade for commodities than, say, the previous decade. And so, in the last decade, we had pretty, going into that, oil reached a peak back in like 2008. Copper did very well in the early 2010s there. And so, commodities were very strong in that environment, while equities, of course, started the decade cheap after the financial crisis and the big recession. And so that was a great decade for equities to do very well. Whereas, here in the early part of the 2020s decade, we have extremely high equity valuations, especially in the United States, but also certain other countries. While most commodities are still, below the peaks that they reached 10 to 15 years ago. There are some exceptions, like, gold touched new highs last year. Things like beef have been going up, lumber's been going up. And so there's certain commodities that have done very well, but in the grand scheme of things, most commodities, if you zoom out far enough, are still pretty cheap, even though they had a good year-over-year run. And so especially when you look at the CapEx cycle, right? So a lot of them don't have a lot of CapEx going in, so there's not a lot of new supply coming online. And so when you have a big increase in broad money supply, when you have the potential for infrastructure projects from multiple countries to try to stimulate their, their economies where possible, I do think the 2020s could be quite a good decade for commodities compared to, some of the mainstream, say 60-40 stock bond portfolio that a lot of people have traditionally had.